Hello everyone, Dave Landry here from DaveLandry.com, and this is your Daily 5. If you've been watching my Daily 5s for a while, you know that I have been bullish. Unfortunately, that's beginning to change. Now's the time where you really need to pay attention, you really need to focus on the stronger areas, and we could see some shorts setting up really soon. Let's dive right in. So if you take a look at the S&P 500, one thing that I find very interesting is we had a record of Landry Light basis of 30 EMA, and this record goes back decades, about 60 years. And you could see recently we had 107 bars of Landry Light. That means that the lows are greater than the moving average, and I found that 30 EMA is a really good moving average, at least for a daily chart to use. And now we're beginning to get some downside Landry Light. Now, as I said a second ago, if you go way back in time, you can see based on this metric, that's a pretty impressive run. This is going back 10 years or so, and if you take a look at the charts way back to the 60s, what's interesting is you'll notice this was the highest number since 1961, and before 1962, the data was close only, and I would imagine if you had the low in there, open, high, low, close, the lows, some of those lows would probably have intersected the moving average. So depending on how you want to look at it, this was a very impressive run that we just had. And I hate to use the word hope, but hopefully we just have a bit of a correction from this run and the market makes a new leg higher. Unfortunately, there's a lot of things that I'm watching that are on the cusp of suggesting that the market could be in trouble. One of them is Bowtie proper order. Proper order is simply the 10 simple is greater than the 20 exponential, and the 20 exponential is greater than the 30 exponential for uptrends, and just the opposite for downtrend. So these moving averages are coming together, so this should turn yellow fairly soon. Now, when you're looking at something like Bowtie proper order, something especially like moving averages that have a lot of lag to them, make sure you also look at the chart. So just because we've been in proper order here for a while doesn't mean the market is still great. And one thing I like to look at, it's probably going to be your best friend when it comes to trading and paying attention to trends, is a net price movement. I simply like to draw a line going back in time to see where the market was a few weeks ago, a few months ago, and even longer. And you can see we've obviously peaked out, and now we've sold off fairly hard from that peak about a month to 6 weeks ago. And then looking back just sideways, we haven't made much forward progress since February, so we're almost at a scratch for the year. So the market obviously has lost some steam. Now let's take a look at the VIX. The VIX only matters when it matters. I'll go months without even paying a lot of attention to the VIX. I mean, I have it plotted on my screen every day, but I don't get too excited about it until and unless it gets stretched away from the 10-day simple moving average. Way back in the 90s, I did some consulting and programming, system programming with Larry Connors back in the trading markets days. And Larry taught me a lot about the VIX, and I kind of took his research and worked to make it better. And one thing he told me was that the VIX tends to revert back to the mean. Now, some of his early research was using fixed numbers, and then the volatility of the overall market increased, and those fixed numbers didn't seem to work quite as well. So what I did with my research was take his words literally, reversion to the mean, and use a mean, a moving average, to measure whether or not the market was stretched. And I found that once you get 10% or more stretched away from that moving average, the VIX tends to correct and the overall market tends to reverse. Now, I have some shorter term systems that are based just on this, and they absolutely print money for extended periods of time. Unfortunately, though, like all short-term systems, they're not completely immune to bad downturns, and there are some ugly periods by following a system like this. So I'm not encouraging you to follow this system per se, but what I am encouraging you to do is pay attention to the VIX when it gets stretched 10% or more away from the 10 simple moving average, and look for market reversals. Now, don't be a hero. Wait for the VIX to begin to implode a little bit and wait for the market to begin to reverse. Also, as I sort of alluded to a second ago, you don't really want to be holding these positions short term. This is more of like an intraday thing. You know that a bounce is coming, and sometimes you can go in and make a little money intraday. So pay attention to the VIX when it gets stretched away from that 10-day simple moving average as it is now. So we're due for a bit of a bounce from this recent sell-off. Now, as I said a minute ago, Larry had pointed out that the fixed numbers in the VIX had stopped working, and I went in and did some relative type of metrics and measurements to use the VIX as a trading system, so to speak. Tom Bowtie in Trading Places pointed out yesterday that when the VIX is 20 or higher, he tends to get out of the way. And that seems to make a lot of sense, although I have to admit I'm surprised that a fixed number like that works. But just from a casual observation, I think he's definitely on to something there. If you take a look at a longer-term chart, you can see these high VIX readings, 20 or higher, seem to be right around the time the market has a pretty ugly spill. And as a general statement, during these spikes higher, you want to be out, or generally out, of the market. So I think he's on to something. I'd encourage you to study that further, because I think there's definitely something there. The only thing, again, I'd like to see more of a relative measurement just to see how that would shake out longer term. Now, let's do a brief update on the TFM 10% system. And as I've said quite a bit, my premise here was once things start becoming bad, they tend to get worse. And bad for this system is 10% or more away from the 50-week closing high. Now, one of my clients pointed out that when you're 5% or more away from the 50-week closing high, that's a good time to think about getting out. I tested it with this system. Looks like you get a lot of whipsaw, but I definitely think he's on to something. So when we dip below this green zone, I would begin to get a little concerned. And now we're at 5015 based on this mark. And we're getting fairly close to that green zone, which is right around 5,000. Here are the rules. We've discussed the system quite a bit, so I'm not going to go into any details. But if you go to my YouTube channel, you can check that out. The sell signal was, the last sell signal was here. And then we did get a buy signal shortly thereafter. And as I've said quite a bit, the buy signals are a little bit more stringent than the sells, and that's to help avoid whipsaw. So the last buy was right there. And so far, it's been a pretty good run. The stop out area would be right below this moving average. You have to close below 10% away from the 50-week closing high, and you have to close below the 50-week moving average. So pretty serious drawdown should that get hit. As I mentioned a second ago, a client pointed out that as long as you're within 5% of the 50-week closing high, that's a good time to be long a market. And when you're more than 5% away, you might want to become cautious. Now, just for S&Gs, I tested this briefly going back to 1984, and I found that it actually works fairly well. You get in the market when you're in the green zone, within 5% of the 50-week closing high, and then you exit the market when you move 5% or more away from the 50-week closing high. So those are the last few buy and sell signals based on that. And you can see we're closing into a sell very quickly. Now, this is just a rough draft. It probably needs to be fleshed out a little bit. I need to check the numbers. But one thing that I noticed right away is, first of all, it did not beat buy and hold for that period. It might beat buy and hold if you go back and get a few more bear markets in there. But what I find kind of amazing with this simple little system is, one, the simplicity. But two, notice that the drawdowns and the losses on individual trades are fairly small. 2 and 3%. I think there's 7%, but that was the maximum. And then it looks like you get pretty much all of the upside. So all of the upside and a nominal amount of downside. So if you're designing systems and you don't have huge drawdowns, even if you're not making a tremendous amount of money, that is a good thing to do, and that is a very viable system. So the point I'm trying to make here is not to follow this system per se, but it's something that shows that momentum tends to beget momentum. And I don't have the drawdowns in here if what happens afterwards, but if you go into markets like 2000, you would have avoided about a 50% drawdown in your equity. So you'd have lost half your money if you weren't using market timing as opposed to using it. So take this system and maybe flesh it out a little bit. Don't make it too complex, but maybe put some whipsaw in it. But there's definitely something here. So again, I wouldn't rush out and trade this system, but it does help to show that staying with the market as long as it's performing well is a good thing, and getting out of the way when it tends to underperform is also a good idea. Now, let's do a brief update in the TFM 10% system in the Qs. As I said last few shows, for S&Gs, I thought it'd be fun to go in and buy the Qs. And to my surprise, we had a really good run, one of the best runs in history. Now, last time when I marked to market, I was up about $12,000. And now you can see I've already given up a couple thousand of that. And at the peak, I was up close to 13,000 in this position. And what's scary is, and this is what long-term trend following is all about, take the good with the bad. And that's why I take a bit of a hybrid approach when it comes to trading. I take short-term profits, and then I hang around just in case there's long-term gains to be had. In this case, I thought I would just follow it mechanically, but it's a big ouch should this thing stop out at current levels. I would only be up 6,800, which is better than the poke in the eye, but you've given up about half of those open profits. So there's no real money management that's built into the system, and the system was not designed to be followed mechanically per se, but more of a system that would help get you out of the way when the market gets in trouble, to avoid the so-called diaper change moments, and that's a term borrowed from Ian McActivey. Here's my contact information real quick. If you need to reach me, davelandry.com/contact. I do have a trading service that I put out daily, and when conditions get kind of iffy like this, you might actually see me go days and possibly even weeks by saying, hey, let's not do anything, let's let things shake out. And it took me years and years and years to learn how to do that. Anyway, so there's the information. We'll come back to that in 1 second. Let's get back to the markets. The semiconductors have been doing really well. And if you go back and look at the last few shows I did, the last year daily fives, you'll notice that I've been bullish because the market has been going up. But with today's action and the recent loss of momentum, I am beginning to get concerned. You can see those bow tie moving averages are coming together. They're getting ready to cut through that 50 simple. And when that happens at a sharp angle, that's usually something to be concerned about. Now, as you can see, we had proper order for a long time, almost 60 days, and that's coming to an end now. So we need to pay attention to that. Now, Bitcoin also very disappointing. You can see that these moving averages are on the cusp of rolling over. And once again, you've got a strong inflection and strong angle of attack, so to speak, inflection point into that 50 simple moving average. And if you zoom in, it becomes a little bit more obvious. And the bow tie pattern is you're looking for the bow ties to flip from uptrend proper order to downtrend proper order over a short period of time to give the appearance of a bow tie in the moving averages. And then you're looking for a higher high and a higher low, or a one-bar pullback, and then you look to get short. Now, as a general statement, the proper order can do a really good job of keeping you on the right side of the market. Uptrend proper order, you want to be long. Downtrend proper order, you want to be out or possibly short the market. So pay attention to the proper order. That's a bit of a bummer. Now, there's not enough time in this segment to go into all the markets that are looking ugly, and there's quite a few of them now. Things change quickly, remember, when it comes to markets. But if you take a look at like PPH, and I'd encourage you to take a look at others too, you can see we flipped over from uptrend proper order, where the 10 was greater than 20 and 20 is greater than 30, to downtrend proper order, where the 10 is less than the 20 and the 20 is less than the 30. So that's no bueno. So on a bit of a bounce, this would be a potential short, and that's major drugs. And there's plenty of other areas out there, so I would encourage you on your own to go study those areas. Now, on the upside, commodities are doing fairly well lately. The gold, the commodity, as you can see, has had nice uptrend proper order for quite some time. We're just off of these multi year highs. These idiots on the radio are finally right. They're always telling you to buy gold. But now you have to question them. Why would they tell you to buy it if it's going higher? Shouldn't they just hold on to their gold? But that's a different story for a different day. But anyway, gold's doing well, so we could see some setups in the gold stocks fairly soon. The only problem is a lot of those stocks are a little choppy, a little erratic, and a lot of them are below overhead supply. But I'm looking for setups there right now, and I think we should be able to find some fairly soon. The other good area right now, speaking of commodities, would be the energies, basis the XLE. You could see we have almost a Landry Light pullback, and that's where you're just looking for 20 or more days of upside Landry Light and then a pullback to the moving average. This is close enough. This also has a bit of a double top kind of knockout look to it. That's another one of the pullback patterns that I trade. But you can see nice uptrend. So we should see some setups in the energies. And these are the energy stocks. We should see some setups there fairly soon. So keep an eye on the energies. Now, in summary, conditions are worsening, and that should be pretty obvious. And I really hate to see the semis topping. I think it's important for the semiconductors to go higher to help bring the market higher. Those two have a good correlation to them. And when the semis start to die off, that's usually bad for the overall market. So pay attention to that. We're due for a bounce based on the VIX, based on oversold, and whatever metrics you want to use. We're really due for a serious bounce in the market. It's what happens next that's important. If it bounces and rolls right back over, that would be pretty ugly. But don't be a hero. Go in and maybe do a little intraday trading for the bounce. But don't try to go in and catch the bottom and hang on, because that's kind of a very dangerous thing. Other than an intraday trade, again, don't be a hero. Now, you want to focus, especially during these times, you want to focus on the stronger areas like commodities and begin to pay attention on the short side. We should see some shorts setting up here fairly soon. In fact, on a bit of a bounce, we should see a plethora of shorts. You're not going to get rich, as a general statement, on the short side. The short side is tough. A lot of times I question whether or not I should do it. I know a lot of professional traders who don't even bother with the short side, especially the ones that are running hedge funds in sizable money, because it is kind of a pain in the butt to short. But the reason I do short is, one, obviously it's the only way to make money in the bear market and when stocks are headed lower. And number two, it does help you to see both sides of the market. So my friends who run a lot of money and are long only oriented by their charters, they tend to be a little bit more glass half full because they're not looking for the shorts. Whereas I think if you do short the markets, and again, it's a dangerous thing to do, but if you do short the markets, you tend to see both sides of the market when things begin to worsen. You start seeing those bow ties to the downside. Well, I'd like to thank everybody for watching. Again, there's all my contact information. I do have a group in Facebook. We have a great group of traders there. I learn a lot from them. I get a lot of setups from them. And it's just one of the best things that I've ever done was creating that group. You do have to be at least a gold member of DaveLandry.com. If you do become a member of the trading service, which I have on sale now, you'll get the gold membership for free. Feel free to shoot me an email if you have any questions and leave comments below. I do read them all and I do answer them all. Everybody have a great day and may the trend be with you.